Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. It's that time of week again where my business partner, Sam Rust, takes over the show and interviews our guests. I hope you enjoy the show.
This is your daily real estate syndication show. I'm your host, Sam Rust. With me today is Dusten Hendrickson from Mailbox Money. Dusten is a South Dakota-based real estate investor who helps his clients invest passively using his creative strategy and years worth of experience in the industry. And when we say years, we're talking about more than many syndicators, been in the business since 2003. Dusten, excited to have you on. Thanks for joining us today.
Hey, thanks, Sam, for having me. I appreciate it. And I hope you're having a fantastic day. And I'm excited for this interview.
Yeah, definitely. I wanted to touch briefly on Mailbox Money and why. We talk about this often in the syndication space, this idea of passive income. But there's a lot of people, perhaps even listening to this show, that are somewhat new to this idea of money that comes in the mail on a regular basis. How have you leveraged real estate to achieve financial freedom for yourself and some of your clients as well?
Well, I've invested in a lot of buildings that pay me monthly rent, and I hardly have to do anything because I've set it up to be more passive. I got a really good team, a good property manager. And they know they know how I like to operate. I don't need to know about every little thing that goes on at the place. So it allows me to just do what I want during the day. Like, I'm busy all day long, but my schedule is wide open. Like, I can pivot and move. If an opportunity comes up, I can go and attack it right away. If something becomes very important, we can just focus just on that, because almost everything we do now is proactive. It's not reactive.
You make a lot more money, both for yourself and your investors, when you can move to proactivity versus reactivity. Having a plan, executing on it, and controlling for as many variables as possible is certainly a key to success. I noticed, Dusten, on your website, I was looking at some of the areas of the country that you invest in, and you're very well traveled. I think I wrote down you've got investments in San Antonio, in Phoenix, Atlanta, South Dakota. I mean, are you just trying to hit all 4 points of the compass, or how do you pick your markets that you're investing in?
So my markets are landlord friendly. So we don't really invest in any liberal cities. Plus, the cash flow in the bigger cities is less, and you got to be an institutional investor. And I'm just not at that level. And most of my clients aren't at that level either. They're just regular Joes that want to have more time freedom. So the Southeast is an excellent market. And then Texas, anywhere in the Midwest. I was told by some statistical guru that the Midwest is a 2-to-1 risk ratio. So the coasts are a much higher risk factor, which you can make way more money, but then you can lose more money quicker too. The farther in toward the middle you go, the less your risk is. And it's a 2-to-1 risk factor in the very center of the country. So we've got that covered from South Dakota all the way down to, Texas. And then we got the high appreciation in Phoenix and Atlanta, which is happening right now.
Yeah, that's very interesting. I've been doing quite a bit of homework on some of those upper Midwest states, your Kansas, Nebraska. I guess that's maybe center Midwest, but then on up into the Dakotas, which is where you're based. In South Dakota, your governor has definitely achieved some level of notoriety, but beyond just the headlines, what are you seeing there in that local market that excites you about South Dakota?
The demographics are really good and the metrics are really good. So it's a high cash flow environment over a high appreciation environment. And then we don't really participate in recessions here, I guess. They barely are blips on the radar. And you get high economic occupancy because everyone pays and they pay on time. There's a good work ethic. The farther north you go, usually the better the work ethic gets as well. So, but it's harder to raise rents, that kind of stuff. You can't get quite the appreciation, but it's very risk averse. So it's good to develop here because you don't really get caught in any boom bust cycles. And so I do some development here, and then I invest passively down south. We got another deal coming up in Atlanta as well, or not Atlanta, Orlando. Orlando.
Okay. So you're investing, maybe would it be fair to say, more for appreciation in the Southeast markets and for yield in your home state?
Correct. But there's still great yield right now currently if you get on a good operating team, down south.
Yeah.
So right now we're getting both, but the appreciation's been bananas.
Yeah, I get this question a fair amount. I'd be curious for your thoughts, Dustin. We have a lot of different investors that invest with LifeBridge Capital, as you do, and different people have different goals with their investments. And some people are fairly new to investing in real estate, and so they're looking at all these different markets that you're in and different deal profiles, and they're wondering, what's the right deal for me? How do you explain the difference, and what's some rules of thumb for investing in different markets that you're exposed to?
Some rules of thumb. Well, I think niche location is actually more important than overall location as far as cash flow, because you'll always be high. You'll have high occupancy always. But location to me is pretty much everything. And then operator is after that. They're both super, super important. If you get a great operator and a great location, you'll make tons of money. Just as easy as that. If you get a bad location and a great operator, you'll still make good money. Even if you get a great location and a bad operator, you'll probably still make money. But if you get a poor location, poor operator, it's not going to be a good investment at all. But yeah, if you can, it's just the operator and the location. If you have those two things, you almost what else is there? I mean, you got to buy right and all that stuff, but those two things are, to me, by far the most important, because a good operator will figure out how to finance right and do everything right.
Yeah.
So
you've partnered with quite the collage of different operators. So you have some experience in kind of vetting and doing your due diligence on your investors' behalf. What are some of the tip-offs that you look for a good operator? And as you're looking,
that I can pretty much, you can trust your gut and find a good operator. I think the only way you really find a great operator is to actually put your money down and go through the whole process. And you need to go with multiple operators, because even your gut, will tell you a really good operator, but they just may be lacking this or that, or haven't found the right partner to fill that gap. But all of a sudden you'll find the right team that's getting off-market deals, like Zag Happenstall, the Rise 48 equity team. You'll find a team like that, and the returns are just completely outsized. And then the deals just come in and you get on their list. And then once you're on their list, then you can't get in after a while because it's too full. But you get on their list initially, and otherwise I don't know how you actually just go and find the best operator right off the bat. I don't know if that's possible. I think that's why I like to just bring in my own money on the new guys first. If I find an operator that I like, I just put 50 down on one of his deals and see what happens.
Yeah. Well, and I think the Happenstall Rise 48, they're a perfect example. A lot of LPs that I talk to, they're like, well, I will only invest with somebody who's been through a full cycle. Well, you're unnecessarily capping your market. I'm not saying that every new syndicator that comes up or has started in the last 3 or 4 years is going to be the best thing since sliced bread, but ultimately doing your due diligence, placing a little bit of capital and exploring what's out there could lead to outsized returns, especially if you pair a really good operator with a really good market like Phoenix, like a DFW, and some of the other markets that are really hot right now.
I'd say you're way too risk averse if you can't put 50 grand down to test an operator in a new market that you like initially off the bat. If you like them, they're going to be fine. They're not going to, unless they scam you or something, which I don't know. It's pretty hard with all the stuff you got to do and the way that you get approved for these loans and stuff. These guys are vetted pretty well. Some people are scams, but it's not, from what I've run into, I haven't run into any of that stuff yet. So
yeah, it's definitely not as prevalent as some people would have you believe. There's a lot of good actors in this space, but there's also a lot of mediocrity. I think that's your biggest enemy, is not the scam artist, but it's the guy who's just operating in a mediocre fashion. I know, Dustin, as part of a GP team that's taking down some of these deals, you bring kind of a design eye with some of your construction background. And something that you talk about on your website and in your LinkedIn content is wellness design. What is wellness design? And could you expound on what that means specifically for apartment investors?
Wellness design is very simple. It's a living quarters, dwelling, whatever you want to call it, unit that makes you feel better when you live there. So it increases your wellness. And that's the purpose of it. Like, we design these things and it brings you to nature. Like, it's the dwelling is supposed to bring you closer to nature than another dwelling that's comparative to it. So the ultimate wellness design is usually in the middle of a forest, and it's like complete windows all around and everything's perfect and you feel like you're outside. So that's the goal, is to just bring you closer outside, bring you more outside, have the space more lit up, more bright, have good lighting. The flow is good as well. It's a very efficient space. And then, usually you need a lighter palette with some raw woods, just real natural stuff. The colors that you see in nature, some plants, different things of that variety, but it mainly has to do with the windows and how you frame your surroundings.
And so when you're coming into an apartment complex, and much like LifeBridge Capital, you guys are focused on value adds. We're typically talking 70s, 80s product, perhaps. A lot of garden style apartments. I'm not guessing wellness design was huge in the 70s, at least based on the complexes I've seen. What are some things that you can do to incorporate some of those elements and make the compound a more attractive place to live, attract new tenants, all those things?
You can over landscape. You can paint lighter palettes on the interior. You can expose the windows better. You can remove overgrown landscaping at the same time. Like, sometimes when you should remove the stuff that's too close to the unit, and it gives you a sense of space and it brings you a little bit more outside. It's pretty hard though to really incorporate wellness design into a really crappy design, but there are some things you can do, but it's a lot harder. It's better to start with something that has good bones. So you can also, when you're shopping apartments, pick ones that have better bones, pick ones that have better floor plans. Like, if you go in and don't want to live in those floor plans, there's a reason. It's just they weren't designed very well. So the better designed floor plan too, which is kind of wellness design, the better you'll have long-term tenants, and the longer you'll keep your tenants. Yeah. And it plays into the community aspect as well. Like, you want to have the coolest property manager. Like, you can't have anyone negative either on your staff. If the maintenance man's negative, that drives people away. So you got to train those guys as well, in my opinion. Yeah. But that whole thing is kind of all community based, friendly, kind, all that stuff, so that people are, good energy. So people are encouraged. They want to be at that place. Like, they want to bring their friends to that complex. Yeah.
Well, it's interesting. We have two complexes that are pretty nearby one another, within maybe half a mile, very similar vintages. But one of them was designed, it was a 2-story apartment. The other one was 3-story, but the 2-story has vaulted ceilings and natural wood paneling in those second floor units. Makes a huge difference. What you can achieve on a per square foot, your turnover, all those different things, just attracts a totally different style of tenant, and somebody who's typically willing to pay more. It has been somewhat eye-opening for us, the difference that a well laid out unit will make. It's not just all about square footage.
So when you first started, you didn't understand, like when you bought the two, you guys didn't necessarily understand that, and then you kind of understood it when you're buying it as well.
We knew that there was a pretty big difference between the two architecturally, and both of them have been fantastic deals. But it has surprised me, even during this COVID time period, how much better the one we've been able to push rents much further with the vaulted ceilings.
Did you pay for it though? Did you actually pay more for the complex because it was a better design, or no?
We paid, it was more units and slightly larger units. And so, because of the design, because of the location, it's slightly different location. We did pay a little bit more, but really on a cap rate basis, it was very similar. So it was just a little bit different, maybe 10 basis points or so. And then bringing in positive management, like you alluded to. That's so important. The previous management had let 20% vacancy and like 30% economic vacancy. It was really run into the ground. They had 100 open service tickets, and wow. you fix those things, and and tenants will be friends for life.
Yep, that's awesome.
So, you have any stories of a complex that you took over where you did some of these wellness design elements, you brought them in, and some of the results that you saw?
No, we're currently doing one in Sioux Falls, but that is a really good location. I mean, that's going to be a home run deal, but I saw what it could be, and I knew it was going to be a home run deal, but the location is also insane. So I don't know if that's just the wellness design. It was a Scandinavian. It's the preserve. It's just south of 229 in Sioux Falls. So it's right on the edge of all the wealth. It's a super good neighborhood. It's right across from a park. There's a river. So I guess that all played into it. And I was like, yeah, when we flip these units, we can get top dollar. So that thing's already a home run, and we haven't even come close to pushing it to its peak, I don't think. I think once we actually flip it, then there'll be another huge adjustment in rents as well when the whole thing is done, versus as we're flipping one at a time,
Yeah, there is a cumulative, a cumulative effect that comes into play.
That is like a home run deal, but it's a location. It's a C-class, a location, mom and pop owner, not sophisticated, didn't know how to raise rents, never been renovated. And the location, I mean, you can't say enough about the location. I think it's mainly all location, but we had all that other stuff. It's a home run. Plus we negotiated right in the middle of COVID.
Yeah.
That was a deal that Chris Pomerleau put together from Park Avenue Capital in Omaha.
So I'm curious, talking to a lot of operators that either were completely sidelined in 2020 or some that were more aggressive and got comfortable. We opted to take advantage of that historic spread between interest rates and cap rates because cap rates froze with fear in the marketplace. How did you solve that problem? Obviously, you were investing in 2020. You were placing funds and closing deals. What was that process like for you?
So there was a point where for 3 months where there was no deal flow. But during that time, I went and refinanced my entire portfolio. So I shaved a point off of all my existing loans and very minimal fees because the banks, there was so much capital sitting on the sideline. Nobody was buying anything. You could still refinance. And so the banks are like, okay. And they just negotiated down and it almost cost me nothing. And I reset my entire portfolio at one point. I don't even know how much extra cash flow that was. Massive, massive move. That was very easy to do. Just completely took advantage of the market. And then as soon as we were looking the entire time, because I've always been under the mindset that multifamily, if it's a deal, it's a deal. When a deal's a deal, you can buy multifamily anywhere. As long as you're going to put decent debt on it and you're fine with holding it, you can buy multifamily. But if you want to sell in 3 or 5 years, then you might not be able to buy multifamily. But even 5 years, we've gotten through everything in a 5-year cycle. So, but yeah, that's, and then we finally started getting deal flow at the end of the year. And it was just like bang, bang, bang. And then everyone by then was getting deal flow again. And then we were back in the cycle. But I didn't take one day off. We also had a development that we stabilized. It actually worked out in our favor probably because I don't think we would have gotten that thing. I don't know if we would have gotten that apartment done. COVID happened and then we got all these additional people to come help us work. So we finished off the complex and then everyone moved in. It was past the pause and then everything moved in and stuff started opening back up a little bit again. But yeah, that first 3 months was nothing was really happening, but we just went to work and hammered out this development we're doing in downtown Brookings. So it was great. I never sat at home in a day. I actually was kind of jealous because we had such a tight deadline that I basically was working from 7 a.m. to midnight or something bullshit. And then, but we got it wrapped up. That's been a great project as well. We got a tenant in the bottom of the commercial space now. So we have like that whole building is full now. So it's pretty cool.
So it was a mixed use development then in Brookings?
Yeah. Mixed use, historical. I had to deal with the historical society, and it was a adaptive reuse. We set the building in through the old historical building. So we kept the main floor was concrete, and we had to go through the floor with these little holes. And then down in the basement, we had to dig these massive footings, and they had to drill all these pilings. They dropped these little skid steers down there. They were moving around. It was crazy. And then we built this platform that sat above it, and then we tied that into the historical storefront. So we kept 4 walls and the floor. Otherwise, everything else got ripped off, and then we set this. Then there was 20 units above. The 20 units. And so then you have units right downtown, so then you get top dollar. It's that wellness design. It's all that stuff.
Oh. That sounds like a lot of vision required to pull something like that off. Dealing with historical structures is not an easy task.
No, but I always am like, there's got to be a way. I just don't think if you want to do it, you can find a way. So halfway through the project, I'm like, man, I'm an idiot. And everyone's like, I can't believe you're doing this. You're nuts. And then it got done and it filled up. And then it's like, okay, on to the next thing. Yeah. But yeah, it requires, I have some sort of vision. I probably should have been an architect, but actually I'm probably a better developer than an architect, because I'm not good with the minutiae. I'm just good with the overall vision and getting someone to understand like what I see. And if I can get the architect to see that, then they just take over from there. So it's pretty cool.
Give them the 10,000 foot view and let someone else sketch out the details.
Yeah.
Makes a lot of sense. I'm curious, going back, you said you refinanced your whole portfolio in 2020 during COVID. What's your debt strategy? Did you put long-term fixed? Did you go floating?
No, it's like so in between on long-term debt that it's just the 5 year. We just do the 5 year term, but we're not we go to the 80%, but everything cash flows really well. And they just adjust in 5 years, I guess. But the stuff I personally, asset management is right on the cusp where it's not really worth it to always go long-term debt. Plus then the fees, I don't know. I looked at a lot of people that got burnt on signing long-term debt, especially last year. Everybody had to hold through. Now some of them are able to sell, but like a lot of their profits are keeping them locked in. They have to keep that profit locked in there. They can't do anything with it. And if they want to exit, then they lose all their profit. It goes to agency debt. So I still think we're in a really low rate environment. So until I see signs that it's going to go higher, then maybe we'll do something, lock in some longer term debt. Who knows? Sure.
Yeah. Everybody loves the siren call of non-recourse debt through some of your GSEs, but you got to watch your prepayment penalties because they can eat you alive. We've started financing more of our deals through some local credit unions simply because they'll give us 10-year fixed, really competitive with agency, but no prepayment penalty. And having that optionality, even if you don't end up ever using it, man, it's really important to have that different exit strategy and not be bound by yield maintenance or defeasance.
Well, and then the refinance, it's just so much easier to refinance and take advantage of that refinance. Like if I was going to refinance on agency debt, I can't do that. I'd be stuck at the 5%. So yeah, just because it's non-recourse agency debt doesn't mean, and it's long-term doesn't mean it's the best. Yeah. It is good though. I'm not going to say it's not good because a lot of our bigger deals have it. So it's still really good, but depends on what you're doing and then how much you want to be able to pivot.
Yeah. Important to match your business plan to the debt product that you're using, which goes back to the operator conversation. Do they have a plan for that specific property and how are they going to go about executing it? So we've come through a very interesting time in real estate, Dusten. I'm curious what you're looking at and what do you see as the biggest risk in commercial real estate in the next 18 to 24 months?
Leases just skyrocketing. I think just higher costs of everything, higher taxes now. If the buildings are worth that much now, any triple nets, they got to pay the higher taxes. Then you got all your repairs and maintenance are going up. So costs are going to be skyrocketing for business owners or building owners, everybody. I mean, that cost just gets passed down. It has to.
Yeah. And what are you doing to prepare for that?
So we're in the middle of a square footage reduction, right? So all these shops, when you go, like, you don't need a J.C. Penney anymore. You can operate from a small boutique store and sell more online. The space is just going to get shrunk down. You can already see it's happened dramatically in like loft apartments. Like, we have stuff downtown. People will move into 350 square feet. If you design it well, it's not bad. But people are living smaller and smaller. Cars seem to be getting smaller. I think the commercial spaces are also just going to follow that same trend. It's like the bag of chips, right? You're still paying 99 cents, but they're like half the size they used to be.
Yeah. On the retail front, I was reading an article that just talked about square foot of retail space per capita or per person in your country. And no surprise, the United States was far and away the leader at 27 square feet of retail per person. But what struck me was second place, I think was a European country, maybe France, but it was down at like 13 square feet per person. So we're more than double number 2 in the world. It's going to be very interesting to see as Amazon continues to take over the world, these fulfillment centers pop up everywhere. We change some of our consumer habits. What some of that retail is going to be repositioned into. That's something that we're keeping an eye on. I'm not sure that's a space that we're equipped to play in. I'm curious, is that something that you're looking at as well? I know you just redid a storefront and turned it into some downtown apartments in Brookings. Any other adaptive reuses?
Local stuff. I'll pivot and adapt and do whatever. If we see value somewhere, we'll go get it. And one thing too is I travel a lot, so I try to pick up these trends immediately. As soon as we see something that starts, is trending, I try to incorporate that right away in the design, and it keeps us 5 to 10 years ahead of everything. And I find that multifamily really lags. Like, people are still using lots of gray paint and different things that are probably dated about 10 years. The trend was like 10 years old. So you can go and you can start picking up the trends sooner. You can start incorporating that, and that way your remodel stays fresher for much, much longer, because you get the front and the back end of it. As far as retail, though, I think overall our country is being Europeanized very quickly. And I think that real estate is just going to continue to get harder and harder to buy, more expensive. People say it's a housing bubble, but just look at what's happened in Canada. So they took the Europeanization. They started there before we did, right? So we can just follow what they're doing. And I mean, European countries, that's what we are. We're just a European country that's, 400 years behind, or however many years behind we are. So we'll eventually, more than likely, we're just following in their footsteps. So Canada's already way ahead of us. Look at their housing prices. They're ridiculous. So we'll sort of follow that trend. And I just think it's going to be harder and harder to buy real estate. I think now we're like in the golden age. I think the 08 recession was just an insane type of crash that more than likely, I don't see how something like that happens unless we go into some kind of Great Depression, and everything's so much different than it used to be. And we can produce so much stuff with all our technology. So nothing really lines up, right? I mean, everything's so much different than it ever has been. So I know, but I just think that we could follow Europe's trends, and you'll see that real estate is insanely valuable there.
Yeah, it's a lot harder to acquire in Europe than it is here, for sure, at least for the time being. Dusten, what's the number one thing that's contributed to your success?
I'm persistent. Probably. I'm enthusiastic though. So what I can do is I can get people pumped about something. So I'm sort of like a salesman, except for I'll even sell them on their own idea. Like, people have a business plan, and if I really, really like it, I can talk so much good about it that they take it to the next level almost immediately. Yeah. So I'm good at enthusiasm, but I'm super persistent. If I want to do something, I'll do it. No matter what, I'll do it. So if it gets in my mind, and I want to do it, then I'll probably do it.
And where do you attribute those traits coming from, specifically persistence? That's
persistence. My autism runs in my family, and my son is autistic, and autistic people are the most persistent people you'll ever see. So I think that persistence comes from that. My daughter's also persistent too. She will figure out how to get her way. She doesn't really want that much stuff, but when she wants something, she'll figure out how to get it.
She's going to burn the boats to make it happen.
Yep. Burning the boats. That's 100% right, dude.
Oh my goodness. Well, last question, Dustin, before we get out of here. How do you like to give back?
How do I like to give back? Oh, I just like to whatever I can. Oh, I got a great story how I like to give back. So there was this homeless man in Sioux Falls this weekend. We stopped at a skate park. He went and used the restroom. He had 2 ladies with him. He comes out, and I mean, this dude looks like a gangster. Like, he looks like the guy that wears the Dodgers cap with the eye tattoo and the shorts, like, like a LA gangster. He looks sort of like that. And he comes over and he's like, "Hey, sir, can I have you? Would you happen to have any water?" Oh no! First he complimented the RV, because we got a new RV and it was just chilling. He's like, "You got a Mercedes-Benz RV? Dang!" And then he's like, "Can I have some water?" And I said, "Sure. Just 1 second." I was like, you ran into the right person. I love water. And I was like, "Would you like still or sparkling?" And he didn't know what to say. And he was basically just like dumbfounded. So I got him 2 of these waters. And then I also gave him a Modelo, because we have a little fridge in there. And I gave him the 2 waters, and I said, "Would you also like a cold beer too?" And he just was speechless. He didn't know what to say. And then he told me, he specifically told me, "I didn't really want this beer. I just wanted the waters." And I really but he couldn't really tell me what he's feeling. So I like to give back that way. Just whatever people need at the moment, whatever that's going to make them feel better, I think it makes a way bigger impact than trying to change the system or whatever. I think if you could just make people feel good, then you're doing your part. And so that's how I like to give back, is to make everyone feel good around me. I don't know. We donate some money to the school, not too much, but we mainly just help individuals.
Awesome. Well, thanks for joining us today, Dustin. It was a pleasure to have you on the show. Best of luck in your ventures, wherever travels will take you.
Hey, thanks a lot, Sam.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.